America invites you to take steps
All right,
to
we got 2
cures
minutes.
at a walk
Sounds
event
good,
near
sounds
you.
good.
Support the 1.6 million Americans living with these diseases. Get started at cctakesteps.org.
This is a special notice to all U.S. taxpayers. If you owe the IRS or state back taxes and cannot afford to pay them back, there's good news. Due to the financial hardship many are facing in today's economy, the IRS has made it easier to settle delinquent tax problems through a federal program called the Fresh Start Initiative. Qualifying for this program will resolve your tax problem, end all collections, and possibly reduce your back taxes by up to 90%. If you are facing wage garnishments, liens, bank levies, audits, or payroll taxes, it's not too late. Your circumstances may qualify you for this special program, protecting your savings and your assets. If you owe the IRS or state back taxes and cannot afford to pay them back, there's no need to worry anymore. Call the hotline at Victory Tax Solutions to see if you qualify and potentially save thousands. For this free information, call 800-813-1105. 800-813-1105. That's 800-813-1105.
Hi, come in. Look.
Wow, your kitchen looks amazing. I love your new cabinets. I've wanted to replace my kitchen cabinets, but remodeling takes so long and it's so expensive.
Actually, we didn't replace our kitchen cabinets. We refaced them. It's a fraction of the
All right,
cost
we
of
got a
new,
lot.
and it looks just as good.
45
And
seconds.
We had it done in just 3 days.
3 days? Less than half the cost? No way.
Yes, and our realtor told us nothing adds more value to your home than a kitchen remodel. It was so easy. We just called 1-800-REMODEL.
1-800-REMODEL?
That's right. 1-800-REMODEL connected
Hello?
us with the top
Yes.
refacing companies and set
Oh,
up
okay.
a free
I'm
design
here.
consultation. The service was great. I selected the perfect
I'm
cabinet
just
combinations from all the
multitasking, doing a
latest
bunch of
styles
other
and
stuff
colors.
while-
And we even got 12 months, no interest financing.
Let's
I
get
had
going.
no idea cabinet refacing was so easy and affordable.
Sharing it on my personal page, all that kind of stuff.
All right, 10 seconds, stand by.
All right.
Design consultation and ask about our
Standing
special
by.
cabinet refacing promotions. That's 1-800-REMODEL. 1-800-REMODEL. Call now.
The following program, paid for by Right Path Real Estate, does not necessarily represent the views or opinions of the staff, management, or ownership of this station. It's time to get on the right path with Right Path Real Estate Radio with Tom Perry. Get the answer to your question that's keeping you from taking action and succeeding today.
Welcome to the show.
All right, hot mics.
All right. Hey, welcome to the show. Welcome to the show. We've got a new producer in the studio. Everybody can say hello to Chris. Hi, Chris.
Yo.
So Nikki's on vacation. Yeah, people are texting me. Apparently, they don't realize that I do this little radio show from 9 a.m. to 10 a.m. So I do keep my phone on silent during the radio show, so I won't be looking at it anymore during the show. For those of you on Facebook, welcome to the show. For those of you that are not on Facebook, welcome to AM 1110 or iHeart or TuneIn or any of the different podcasts that we're on. So welcome to the show. If you want to follow us on Facebook, all you have to do is go over to Right Path Real Estate on the Book of Faces, and you can actually watch the show as well as listen to it. And what our show is about is really helping people to change their life through investing in real estate. And, we think that the number one way that you can invest in real estate is passively through buy and hold real estate. And mainly in single family. You can do buy and hold and multifamily, although we're not a big fan of that strategy for right now, just due to market timing. We think that multifamily is more like a business than it is a piece of real estate. It's more like buying a machine shop. And it's interesting. I give this analogy a lot when I teach classes from the stage. Imagine that you wanted to buy a machine shop. And I'm just going to make up this imaginary machine shop that it does $1 million a year in net profit. And the owner lives in the Bahamas. And he lives, sleeps, breathes, stays in the Bahamas, never goes and visits his machine shop that's in Houston, which means that, in Houston, he's got to have a CEO, a CFO. He's got to have, his billing set up, accounts receivable, accounts payable. He's got to have all the manufacturing, the sales, the marketing, all that set up to run by itself in his absence. So if you know the Robert Kiyosaki book, Rich Dad, Poor Dad, that would be in the B quadrant of being a business owner, where he can be gone 6 months or more, the business runs itself, not the S quadrant where people are self-employed. And in fact, if you're not familiar with the Robert Kiyosaki book, you ought to pick up a copy. 2 books that we recommend when you're first getting started, investing. One is The Millionaire Next Door. It'll change your mindset about what millionaires really look like. And then number 2, and not just what they look like, but who they are, what they do, how they got there, all of those kind of things. It'll dispel a lot of myths that the media puts out there about what millionaires do and how they act and things like that. And the second thing is the book Rich Dad, Poor Dad by Robert Kiyosaki. And so imagine that you have this machine shop, $1 million a year. I ask a class, hey, what would you pay for that? And most of the class will have, 401ks, they have IRAs, they're investing through savings, all that kind of stuff. They'll, sometimes there's people that work for maybe the fire department, the police department, that kind of stuff will come to our class. They've got pensions, which are in terrible shape, because the city's done a horrible job of investing that money. Any city, doesn't just have to be Houston, but Houston's in bad shape. Dallas is even worse. Detroit, oh my God, don't even talk about it. So imagine you've got this machine shop. Then I ask, well, hey, do you have them, would you pay $1 million for that business? Assuming that the owner wants to sell, that's the assumption in the problem. We want to assume that the guy, he's tired of making $1 million a year. He wants to cash out. He wants to sell it for as much as he can. How much would you offer him? Would you give him $1 million? Now, most people start thinking in their own mindset, I can't stroke a check for $1 million, so therefore I wouldn't buy it for $1 million, right? And no, you got to get if you'd be willing to pay $1 million, I'm sure you could raise private money because it's a good deal at $1 million. I mean, it pays back in a year. So even if you took 2 years to pay it off, finding the money on a deal like that would not be hard. Then I ask, okay, well, would you pay $2 million? And they say, yeah. In fact, I met with a guy yesterday in my office, and I said, hey, would you pay $3 million? He goes, that's a 3-year payout. And then I'm thinking, man, that's a 33% rate of return. And keep in mind, it's completely passive, right? I mean, you wouldn't pay $4 million, which is a 25% rate of return. He goes, well, maybe $5 million. That's a 20% rate of return. 20% rate of return. I mean, Buffett got really, I guarantee you Buffett would pay that kind of money for it. I mean, it's a small deal for Buffett, and the problem is he's got billions and billions he's trying to invest, not just, $5 million, right? That's hard for him. But a 20% rate of return is tough to turn down, $5 million. Then what about 6? Then what about 7? What about, you get to about 7, everybody goes, oh my God, no way, I wouldn't do that. Would you get to 10? Would you pay $10 million? That's a 10% rate of return, which if you understand how commercial real estate is sold, that's called a cap rate. Whatever the rate of return is, and again, we're assuming that it's completely passive, that's the cap rate. So a 10 cap would give you a 10% rate of return, which means if the property's making $1 million, you're paying $10 million for that. Now, and that's how multifamily or commercial real estate is sold, is based on a cap rate. It's a revenue stream, and you would increase. Now, keep in mind, if it's sold on a 10 cap and I can raise the revenue on that $1 million a year machine shop from, let's say, $1 million to $2 million. And so by either cutting expenses or increasing sales or increasing profit margin, whatever that decreasing expenses, increasing revenue, we increase margin, all of that. So if I can get to $2 million a year net profit, then now it's worth $20 million on a 10 cap, right? So that's what a lot of multifamily players try to do by either increasing rental rates, decreasing expenses. But what you're relying on there is that, someone's inefficiently managing the property. And yes, that does happen, but we're at record high rental rates and record low cap rates and record high occupancy right now in the multifamily space, really across the country. So, and then there are also cycles in business. If I ask people, hey, would you like to buy a business low or would you like to buy a business high? Most people say they'd like to buy a business low and sell high. I mean, that's duh, everybody says buy low, sell high, right? So if that machine shop, would it make more sense to buy a machine shop when it's not doing well, like when oil and gas crashes and there's less business for the machine shops, or if manufacturing crashes, there's less business for machine shops in general. Machine shops aren't doing well. That'd be nobody wants to buy a machine shop when they're not doing well. Wouldn't that be a great time to buy a machine shop? When machine shops are booming and they've got all the business they can handle, I would think that that's when owners want a ton of money for a machine shop. But do you realize that when you buy the entire business, it's easy to say I would pay this or I would pay that. But when we put money in the stock market, most people, number one, don't even know what stocks their money's in because it's in some kind of managed fund or things like that. And they don't ever go and look at the underlying stocks. But I asked this guy in my office yesterday, I said, just pick any stock whatsoever, and let's look up what you're paying for that stock. So he said, okay, how about Exxon? And Exxon's up 2% today. And Exxon, in any stock, what you're looking at is what's called a price-earnings ratio. There's a ratio, the price divided by the earnings is going to tell you how many years in the future. In other words, I was asking, would you pay $10 million for $1 million a year of net income? And most people say no. And that would be a 10 price earnings ratio because you'd be paying $10 million. That's to be the price divided by the earnings, $1 million. That gives you a 10. And people say, oh, no way. But if I say, hey, would you invest? Would you feel comfortable owning Exxon? Everybody goes, yeah, Exxon's great. Awesome. Everybody knows Exxon because you're familiar with the name, right? Right now, Exxon's trading at a 24.74 price earnings ratio. I just want you to think about that for a minute. A 24.74. That means that same $1 million a year on a machine shop, that means that you'd be willing to offer $24,740,000, almost $25 million. 25 years worth of revenue. It takes you 25 years to pay it back. That's what you get if you put money in Exxon right now. Now, how does real estate compare instead? Well, single family, right now we've got an appreciating asset. We've got a piece of property that if you're buying in the right price range, we see people make mistakes doing single family and then they say, oh, single family didn't work for me. No. How you did single family didn't work. There's a right way to do single family. There's a wrong way to do single family. And if you do single family wrong and then you say it doesn't work, don't blame that on single family. Blame it on how you did it. If I buy $1 million house and it rents for $4,000 a month and it doesn't cash flow, I would say don't rent $1 million houses. If you did that, and it doesn't work for you, then you say it doesn't work. And I'm like, no, you did it wrong. Instead, what I would say is, wouldn't it be better to buy like $750,000 houses that rent for $1,500 a month instead of $1 million house that rents for $4,000 a month? If you want to join in this conversation and ask, yeah, but Tom, what about this? Feel free to do that. 713-785-1817. I recently bought the domain name getyourbuttsanswered.com. And I say that, I can say that on the radio because I mean B-U-T-S. I spelled it the other way I got both of the domain names, but I spell it getyourbuts, B-U-T-S, answered.com. There'll be a website coming up on that where you can get questions like this answered. But if you want to take part in the conversation right now, feel free to give us a call, 713-785-1817. Hey, stay tuned during the break. We'll keep going. Thanks for listening. Hey, morning, Matt. Good morning, Brian. Good morning, Ginger. Good morning, Patrick. Tiger. Chad, Daniel, Sonia, and is it Dink? DNK? Hello.
Are you looking for an investor-friendly general contractor for your investment property? Then call Fast Track Remodeling at 832.
I'll be right back after the commercials, guys.
9992, or reach us on the web at fasttrackremodeling.com.
Fast Track Remodeling specializes in turnkey remodeling of single-family investment properties, whether it's a flip rehab or a rental rehab. No more managing it yourself. No more doing the work yourself. Fast Track Remodeling really does manage it all.
So give us a call today at 832-742-9992.
Hello, real estate investors. Do you need a lender that moves fast at the speed of a jet to fund your investment properties? Jet Lending will help you purchase properties quickly with as little cash out of pocket as possible. Jet Lending also sets up a repair escrow fund to help you with repair costs. Jet Lending is your fast and friendly hard money source for first-time investors and seasoned professionals. Call 281-872-7800 or email us at info@jetlending.com.
Time is money in a real estate deal. If your insurance company is slow or non-responsive, you could lose a deal like that. You need a quick turnaround on quotes, binders, and the agency for that is Benchmark Insurance Group of Texas. The team at Benchmark understands the investor mindset. They know what you need and when you need it. It's there for you. Call Houston's leading real estate risk management experts. Benchmark Insurance Group of Texas, 281-569-4353. That's 281-569-4353. Or online at benchmarkbroker.com.
Are you a realtor or seller that is concerned about the new TRID rules and closing on time? I'm Jennifer Hernandez, Senior Loan Officer at Legacy Mutual Mortgage, and we have mastered the 30-day close. We close on time, accurately, and with tons of communication. You'll have a dedicated team of a coordinator and a contract-to-close associate. Give me a call today at 713-579-3611, and let's talk about how we can help you on your next transaction. NMLS 514497.
Real estate investors, if you're not familiar with
got it.
IRA,
that makes sense.
what you're missing.
You have a call?
We've got
Oh, I do? Okay,
free
cool.
Educational classes, networking opportunities, and the ability to tap into trillions of dollars for your real estate
Who is it on the
investing
call?
deals. Come by our office
I didn't
or
get the
join
name.
us remotely
Okay.
as we simulcast all of our educational classes
What an unusual.
every Tuesday morning and evening. For more information, call us at 1-855
We have how many minutes left?
Fun IRAs or visit our
we got
website at
a little over a minute.
questira.com.
All right, cool.
Selecting a foundation company and their product for repair is a lot like a game of chance. You simply don't know what you're going to get. The foundation repair industry as a whole doesn't carry a license, nor is it regulated. However, Foundation Check utilizes professional engineers to review all of our files to give you the best foundation analysis in today's market. Remember to check before every repair. Call 346-702-3825, or you can reach us online at foundationcheck.com.
You found or inherited a great investment property. Problem is, you don't know how much it's worth, or more importantly, what to do to maximize your investment while mitigating risk. This is exactly why we started Next Gen Appraisals. Next Gen is a group of appraisers specializing in investment real estate. We understand that investors aren't just looking for a number of what their property is worth, but
His
a
name is
comprehensive
Al
analysis
Sterling.
of the market.
Okay.
Give Next Gen a call at 713-346-9911 or check us out online at nextgenappraisals.com.
30 seconds.
Sure.
Taxes. Just the sound of that word makes people cringe. At Anderson Advisors, we provide tax reduction through asset protection for real estate investors throughout the country. Our unique philosophy has CPAs, lawyers, bookkeepers, and estate planners with one common goal, helping you, the real estate investor. Check us out today at andersonadvisors.com, and don't forget to tell us you heard about
Stand
us
by.
at Right Path Real Estate.
This is Business 1110.
Hot mics.
Hey, welcome back. Right Path Real Estate Radio, 713-785-1817 is our call-in number if you want to join in the conversation. Al has put his fear of calling behind him, and he's called in. Al, welcome to the show. How can I help you?
How are you doing? First, I wanted to say thank you again for the wonderful
The case study event on Thursday?
last Thursday.
Yeah.
Yes, you did the case study. It was awesome. Now, my question is, of course, I explained to you that I wanted to do a lot of buy and hold, and of course, we're looking in neighborhoods that are suburbs, such as the Fort Bend area, Missouri City, Katy, Cypress, stuff like that. Now, don't they have a lot of homeowners associations that prevent the number of rental properties in their neighborhood?
Not typically. Yeah, there's federal laws that are fair housing laws that homeowners associations can't prevent you from conducting commerce. And so, yeah, there's not typically, I mean, it varies. I don't know every single homeowners association's bylaws, and I'm not saying that there's not a homeowners association's bylaw that doesn't restrict that. However, what I can tell you is that those are not enforceable from a federal law standpoint.
Okay.
Yeah.
Well, thank you, because I'm very interested in your passive investor network.
Absolutely.
As many properties that they can provide for me, and learning from those experts and moving forward.
Yeah, thanks. Well, look forward to you being a part of that. Thanks for joining the show, Al.
Hey, thank you again.
All right,
You
sure.
Have a great day.
Oh, you too. Yeah, in fact, what we do is we do a free event where we talk about comparing single-family buy and hold versus any other real estate investment. And it's called the Wealth and Income Workshop. And it is completely free of charge to come to. Our next one is going to be tomorrow evening. Starts at 6 o'clock. You can head on over to our website, rightpathrealestate.com. That's rightpathrealestate.com. You can register for it. There's no fee to register. Like I said, it's free of charge. We're not playing any kind of games or anything like that. There's a show on this same station that go, if you're caller number 10 through 20, then you win. I'm like, wait, that's so crazy. Why wouldn't you do like 1 through like the first 10 callers, right? So can you imagine being, okay, you're caller 7, sorry, you lose. I mean, it's like, wait, I just want to go to the workshop. Why do I have to play these games? And I know it's a gimmick, it's funny, but when you get, we don't like those kind of gimmicks. We just want to be just keeping it real, practical real estate investing. We tell the truth. We tell you what we know based on what we're doing. If I were to stop doing real estate, what I teach would be obsolete in about 6 months. And the sad truth is, if you go to most real estate gurus and you ask them, hey, are you doing real estate? Oh, yeah, I do 3 or 4 deals a month. It's not true. And I can prove it to you. All you got to do is just say, hey, what LLC or what entity name do you purchase houses in? Or better yet, hey, what title company do you close properties at? Like our radio show sponsors, Texas American Title. I'll just put it out there right now. The name that we buy houses in is HoustonHouseBuyers.com. So all you got to do is go to HCAD or Fort Bend CAD or Montgomery County CAD. Go to the counties that you know that they claim to be doing business in and just look and see, are they the grantor or grantee on anything? Oh, no, he didn't. Yes. All you got to do is just ask, what's the LLC? Yeah, look up HoustonHouseBuyers.com. See how many deals we're doing. Or, call Texas American Title. Hey, have you ever heard of these yokels called Houston House Buyers? They do any deals? Yeah, they'll tell you we're buying houses, lots of houses. We're fixing it up. We're flipping them. You can ask to, are they making money on their HUDs? They can't give you, disclosure laws, they can't tell you how many, but come on, just ask. They can tell you if we're doing deals or not. Be funny if you called up the title company of some other guru and that they give you the name. Most of the gurus, we do lots of, we joint venture and we use lots of names. And then bottom line is they will not give you an answer. They will hem and haw and they will not give you an answer. It's just crazy. Oh, well, we wholesale a lot of deals. We're not on the, whatever. Anyhow, enough about that. I don't have to. It bothers me. All the bad information's being taught out there because they're not in the trenches doing it. I know of one guy that, he did a bunch, allegedly, 20-something years ago, and he still teaches single-family buy and hold today. And I'm like, dude, you've not even done a deal outside of your own residence, 20-plus years. Well, what you're teaching doesn't work. The way, you can buy a house with $3,000 out of pocket. No, you can't. And it's the reason why very savvy people that have been investing for a long period of time come to us to figure out, why is what I used to do not working? Give you an example. If people don't understand what happened when Dodd-Frank passed, when Dodd-Frank passed, before Dodd-Frank passed, almost anybody could get a mortgage loan. And so you could fog a mirror, get a mortgage loan. So because of that, that put a lot of people that shouldn't have ever been buying houses. So in a healthy real estate market, if we're going to go after $150,000 houses, as an investor, I want to buy the non-retail ready houses. I don't want to compete against end-user owner-occupants. But what I'd like to see is 8 or 9 out of every 10 houses go to a retail seller, and then I'm buying at a discount to that retail sale at some, let's say they're buying at $150,000 retail, move-in ready. And then I can buy that house maybe that needs work, maybe needs, foundation work, and it needs plumbing work, and it needs a new air conditioner, it needs to be painted, it needs the flooring replaced, it needs new kitchen countertop, it needs some work, maybe it needs $30,000 worth of work. So no retail buyer wants to buy it for $150,000. In fact, it's not even worth $120,000 because somebody's got to get paid for doing that work, right? So it's going to be worth less than, the retail price minus repairs. Is not worth $120,000. So maybe I can pick it up for $70,000, maybe $75,000, put $100,000 in it. Now I'm in it for $105,000, but I've bought it at a discount to retail, right? Well, when Dodd-Frank happened, then two things changed. One is the people at the lower end of the spectrum, people that can qualify for a $150,000 house, it became much more difficult for them to meet the Fannie Mae guidelines to qualify for a house. The second thing is most people don't understand how the mortgage market really works, and most mortgages are bundled off and sold on Wall Street, in billion-dollar packages. And so when investors look at what's the underlying mortgage really, who is the asset, and that's the borrower, right? The people that are making the payments. Do we want to take a risk on 4% mortgages, on 4% money, on people that make, combined household income, $70,000 a year? That means one person's making 30, somebody else is making 40, but you got $70,000 a year combined income. That's not a real safe investment at 4%. Because keep in mind, return versus risk. You're taking a lot of risk, not very much return. If interest rates were higher, then we'd find that it's easier. More investors would take risks like that. So what ended up happening is the retail market dried up. So then it started becoming mainly investors buying at that price. So if I'm an investor and I buy at $120,000, it's hard to buy at a discount to another investor. You can buy at a discount to retail, but it's hard to buy because if I'm buying at $120,000 and now you say, well, I don't pay retail, but I'm an investor, I'm not really retail. So, but you want to buy it, let's say $100,000. Well, then I don't want to pay retail and you're retail, so I've got a comp at $100,000. Well, now I want to buy $80,000. Well, now you want to buy at $60,000. Well, now I want to buy at $40,000. I mean, where does that stop? And where the craziness stops is when cash buyers step in and say, I've got unlimited cash, which is hedge funds, that's REITs. And when retail is really investors buying houses, it's not really retail. And what I'd say is for the last several years,
2 minutes,
the bulk of the properties being bought in that 150 price range, it's kind of inverted. It's been like 7 or 8 out of every 10 properties has been investors buying those, and 2 or 3 have been end-user owner-occupants that have saved their money, have a down payment, qualify, they have good credit. I mean, they're starter homes like that. And they're people that, aren't renting higher-end properties. Everybody knows that there's been, most people used to graduate from college, get their first job, first thing they do, get married and get a house, start having babies, right? Well, now people aren't doing that. They're graduating from college. They're the socioeconomics of it. People are staying single longer. They're getting married later. They're not buying houses as soon, straight out of college, getting their first job. They're falling into the trappings of wealth. They're buying the BMW. They're read Rich Dad, Poor Dad, read The Millionaire Next Door. They're not doing those things. And so if you don't understand that that's what's going in the marketplace and you go, where are the deals? The deals are right there in front of you. It is an amazing deal to buy a piece of property, even in what we call retail, because it's not really retail. But you could buy a single-family house for $150,000 that rents for $1,500 a month, put 20% down, and you'd be killing it. I mean, 30% rates of return are not out. Now, again, I'm laying claims here. Your results may vary. If you're not doing it the right way, results are not typical, blah, 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 all those disclaimers, right? Gotta have the legal ease put in there. I don't want to get sued for saying, Tom told me on the radio if I bought a $150,000 single family house, and yeah, but you did it, the house wasn't fixed up. You bought a $300,000 house for $150,000 and the numbers didn't work. I mean, you gotta understand all the steps of the process, so don't take it out of context. Hey, you're listening to Right Path Real Estate Radio, 713-785-1817, 713-785-187. I want to change your better future, and I want to thank you for listening. I want you to stay tuned through the break. We're going to keep going.
Mic's off.
Thanks.
Are you looking for an investor-friendly general contractor for your investment property? Then call Fast Track Remodeling at 832-742-9992 or reach us on the web at fasttrackremodeling.com.
Fast Track Remodeling specializes in turnkey remodeling of single-family investment properties. Whether it's a flip rehab or a rental rehab, we manage every aspect of a rehab from start to finish with a highly efficient, standardized process.
Over the last 6 years, Fast Track has completed over 700 projects, which has helped us to create our 3 keys to success. Use a detailed scope of work so that everything gets done, train and maintain quality crews so it gets done right, and complete the work in a proper order so it gets done fast.
No more managing it yourself, no more doing the work yourself. Fast Track Remodeling really does manage it all.
So give us a call today at 832-742-9992. Again, that's 832-742-9992, or reach us on the web at fasttrackremodeling.com.
Time is money in a real estate deal. If your insurance company is slow or non-responsive, you could lose a deal like that. You need a quick turnaround on quotes or binders? The agency for that is Benchmark Insurance Group of Texas. The team at Benchmark understands the investor mindset. They know what you need and when you need it. We're here for you. Are you a rehabber, wholesaler, buy and hold, or flipper? Bundling your properties on a single policy will help save time and money. Benchmark has been in business for over 10 years, and we insure over 30,000 properties. Contact Benchmark about our exclusive investor package. Call us and let us show you what we can do for you at 281-569-4353. That's 281-569-4353. Or online at benchmarkbroker.com. That's benchmarkbroker.com. That's 281-569-4353. Or online at benchmarkbroker.com.
Are you expecting to close
Back in two.
accurately, on time, and with lots of communication on your home purchase? You've come to the right place. I'm Jennifer Hernandez, Senior
Hello.
Loan Officer with Legacy Mutual Mortgage. Our goal is to give our borrowers and referral partners an amazing experience during the loan process. My team believes in putting people and culture before results. Our company concentrates on building those teams who operate with structure, process, and recognition for going the extra mile for you. This way, we have the energy to make this your best home purchase ever. Give
Hello.
us a call today to find out the simple steps to get started. I'm Jennifer Hernandez, the Hernandez team at Legacy Mutual Mortgage. Jennifer.legacymutual.com or call 713-579-3611. Again, Jennifer.legacymutual.com. We can't wait to consult with you soon. NMLS 514497.
Equal Housing Opportunity Lender. NMLS 514497.
Hello,
Back
real
in
estate
one.
investors. Do you need a lender that moves fast at the speed of a jet to fund your investment properties? Jet Lending will help you purchase properties quickly with as little cash out of pocket as possible. Jet Lending also sets up a repair escrow fund to help you with repair costs. Jet Lending has originated over 2,000 loans in Texas, valued at over $250 million. Jet Lending will help you evaluate your deals for free and give you feedback on value, cost of repairs, and potential loan amount. Jet Lending is your fast and friendly hard money source for first-time investors and seasoned professionals. Call 872-7800 or email us at info@jetlending.com. Oh, and don't forget
Stand by.
about our famous Third Wednesday Super Investor Networking Meeting. Lots of fun, lots of great real estate talk. We'll see you there.
Appreciate it. How much time?
This
Coming
is
back right
Business
now. All right.
1110.
I'll turn it up. Hey, welcome back. Right Path Real Estate Radio, 713-785-1817. Hey, Jason, welcome to the show. Man, you're up bright and early. It's 7:30 where you are. So thanks for joining. So we're talking about real estate as an investment vehicle. And what we do is now, when we started Houston House Buyers, we started it back in July of 2013, and the idea was we wanted to flip properties, we wanted to wholesale, we wanted to do buy and hold. But what caught us at the time is that Fannie Mae changed their guidelines, and there really weren't any other investment vehicles. What happens is, anytime that a pendulum swings in the economic marketplace, or in government regulation or whatever it is, anytime that there's some kind of legislation, it normally causes a pendulum to swing and overcorrect. So we had a problem in lending pre-Dodd-Frank. And the problem was that people were getting loans that shouldn't have gotten loans. They really didn't financially. So you could state whatever income you wanted to state, and nobody verified it. You could, you didn't have to prove any kind of. They called them no doc loans. You didn't have to have any kind of documentation that you made any money, that you had any money, any of that kind of stuff, and you could qualify for a mortgage. Which is, that's craziness. Looking back on it, it's just crazy talk. And then Dodd-Frank set to fix those problems and some other problems. And again, it wasn't a great law. It was an okay law. There was a lot of bad things about it. But what happened was it caused the pendulum to overcorrect. And it used to be for investors, for example, you could buy 10 properties in your name, assuming you qualified for Fannie Mae. And then what you would do is, and Fannie Mae, what's great about them is it's a government insured loan, and you have really like a subsidized interest rate. Because it's guaranteed, you're reducing the risk, so investors are willing to take less of a reward because there's not as much risk, right? So back then you could get like a 4.5% mortgage on an investment piece of property, and as long as you were willing to put 20% down, they would finance 80%, which is a great deal for investors. In fact, you could even buy with hard money and do a purchase and a rehab. And then as long as the entire amount was below 80% of appraised value, not 80% of purchase, then they would refinance out even more money than they would have given you just if you had purchased it straight from them, because they wouldn't have given you the rehab money, and they would have been 80% of purchase, not 80% of the after repair value. But they would refinance out more because if you already had a mortgage there, and they consider a hard money loan a mortgage. And so they'll do a rate and term refi. That's the reason why it was so smart to do hard money loans for purchase and rehab, and then you just refinance out. And then once you got to 10, what you could do is you go to a commercial lender, and you would roll those into like an LLC, and you'd refinance all 10 of those, and that would free up your 10 loans. And then they got the mortgage business got savvy, and they said, hey, we got an issue here. We recognize that you've got more than just these 10, and we feel like it's more risk than what we're getting in terms of return. So if you own even 25% of an LLC that has any mortgages, and that counts against your 10. So if you had a commercial mortgage that had 10 houses on it, that counted as your 10. And so at any one time when we're flipping, we've got a lot of, deeds of trust, which are basically mortgages. Most of them there's some hard money, that's some private money lenders. But at any one time, we might have $8 or $9 million worth of debt, so our DTI was way out of whack. So we didn't qualify for long-term financing for buy and hold. So we had to either do subject to buy and holds or seller finance buy and holds, things like that, to build a small buy and hold portfolio. But we've always been a huge fan of buy and hold. And then we started doing more and more math about it, and realized that for every month we weren't doing a buy and hold, it was costing $1,000 per month for that per property. So if you buy 10 properties in the next 6 months, you're making between cash flow and appreciation about $1,000 a month per property, which is just crazy. Because, right now, if you're buying a $150,000 single-family house in Houston, then that's below replacement costs. And when I say that, I mean like an ARV on a house, and that's like in a rental house. And as long as you're not doing it in certain areas, like Springs, an area, for example, that has a very high percentage of rental properties versus owner-occupied properties. I mean, there's parts of Spring that I would say are 65 or 70% investor-owned versus owner-occupied. Now, the problem with that is those houses don't appreciate much because not enough of them sell, and when they do sell, it's one investor selling to another investor, and they need work, and you've got a reluctant landlord or a landlord that doesn't know what they're doing or is a poor landlord, like they're mismanaging properties, etc. Or you get a tenant that just tears it up, and now you get a disgusted or angry or mad or frustrated landlord, and they just want to dump the property. And when they get dumped like that, that lowers the value, so it reduces appreciation. And so, but if you go into other areas where it's like 70% owner-occupied, 80% owner-occupied versus 20 or 30% rentals, we're seeing about a 7% appreciation on average. And one of the best reasons why single-family buy and hold is so amazing is leveraged appreciation. Imagine if I have a $150,000 house and it goes up 7%. Well, that's like $10,500 in appreciation in a year. And you may say, well, I don't get really excited about a 7% rate of return. A lot of people want to get more return than that. Well, you could put 20% down on that $150,000 house and leverage that house 5-to-1. And in our class, we oftentimes talk because, we have, it's amazing. We have a lot of Asians that come to our class. We have a lot of Indians that come to our class. We have a lot of Pakistanis come to our class and a lot of Hispanics. And culturally, they like paying cash for things. And they're tremendous at saving their money, building wealth long-term, and nothing wrong with that. But when you start talking about leverage, and again, it's contrary to Dave Ramsey, but I'm not talking about consumer leverage. I'm not talking about consumer debt is bad. I don't like consumer debt. I don't like, leverage on cars and things like that. Pay off cars as quickly as you can. Pay cash for cars. What I do like is leverage on an appreciating asset. If I can have $30,000 down on a $150,000 house, so I'm 20% in, that means that I get the full $10,500 increase in value on the house, that grows my equity by $10,500. Equity is wealth, right? Grows my wealth. It's not growing my income, but it grows my wealth. It grows my net asset value, $10,500, but it's on a $30,000 investment. I can't go buy $150,000 worth of Exxon stock for $30,000. It takes $150,000 to buy $150,000 worth of Exxon stock, so I don't have any leverage. But on a single-family house, because of leverage, that means that $10,500, if I pay $150,000 cash for the house, I'm only getting 7%. But if I only have $30,000 in on the house, I'm still getting the same $10,500. That gives me a 35% appreciation leveraged. I mean, 35%, folks, that's amazing. Now, what if it's not 7% appreciation? What if it's only a 4% appreciation? I mean, still 4 times 5 is 20. That's still a 20% rate of return on appreciation alone. And this doesn't work in California. This doesn't work in New Jersey or New York. It doesn't work in the coast. The reason why is, yes, you could potentially get appreciation. However, it's not based on like the economy growing. It's not based on people moving into the area. It's not based on strong jobs and the fact that you're buying houses below replacement cost and below median cost. It works in California. Appreciation works only because there's more and more money wanting to go into that, and there's no place else for money to go, so it drives the prices up. But what's amazing about Houston versus like California, New York, or New Jersey is that I can buy that house and it cash flows also. In other words, I can have if I put 20% down on a $150,000 house, now it's a house that I only owe $120 on, and principal, interest, taxes, and insurance on $120,000 worth of debt should be about, I don't know, let's call it $1,100 a month. We do $100 a month in mortgage, in a property management, and that's now my payments are $1,200 a month. It's a house that I fix everything on the front end, so I don't have an air conditioner that's going to break or a roof that's going to leak or anything, unless they're damaged, but I have insurance that's in that PITI, the principal, interest, taxes, insurance. Insurance is included. That would fix my roof or any other damage that gets happened by weather, things like that. And that house should rent for $1,500 a month, so I get $300 a month cash flow. My tenant's paying my mortgage. So if I'm making $300 a month cash flow, that's $3,600 a year. That's 12% on my $30,000 just on cash flow. So I get the appreciation and cash flow. There's not a ton of areas in the United States that you get cash flow and appreciation. L asked the question, what happens if your capital is low to start? How do you get the funds even with a hard money loan? Yeah, so I know of one person. That's a great question. Thanks for asking, L. You know, I know of a guy in town that partnered. You know, sometimes I don't believe in partnering for building a real estate business like Houston House Buyers or to partner on flipping houses because that's the most expensive money in the marketplace today. You know, we flipped a house recently. We made $70,000. And we were in and out in, let's say, 8 months. And I want you to do the math. Do 3 and 14 or 3 and 12 on hard money. Calculate what you would pay over 8 months on a... But we gave up 70... We made $70,000 on our flip. We would have given up half to a money partner. Partnering just for the money is expensive money. We'll talk more about that on the other side because I am in favor of partnering on buy and hold. You're listening to Right Path Real Estate Radio. Our call-in number is 713-785-1817. Thanks for listening, guys. Stay tuned through the break.
Mic's off.
Hi, Clint Coons here, attorney and avid real estate investor. You know, the greatest mistake real estate investors make is not understanding the potential liability that exists from owning real estate. At Anderson Business, Legal, and Tax Advisors, we specialize in protecting real estate investors in all 50 states. In addition to structuring your business for optimum protection, we provide guidance so you pay the least amount of taxes available under the law. We have 150 employees that range from lawyers to CPAs to estate planners and much more. Download our free ebook, The Invisible Investor Strategy, today at AndersonAdvisors.com or call for a free risk reduction analysis and financial blueprint at 800-706-4741. Anderson Business Advisors will help you keep more of what you earn. Call us today at 800-706-4741 and mention Right Path Real Estate.
Do you have cracks in your brick, doors that stick, or sheetrock that's coming apart? Then you may have foundation movement. Due to our expansive soils in the Houston area, it's probably not a question of if you have movement, but when. Call Foundation Check for a truly independent, unbiased foundation evaluation. Foundation Check has been in business since 2009 and has completed over 1,400 evaluations. We're not in the business of repairing foundations or selling you unnecessary peer work, but we are in the business of evaluating your foundation. Our product is designed for house flippers, landlords, or even owner-occupied properties. Each of our files is reviewed by a licensed engineer. Remember to check before ever repair. Call 346-702-3825. That's 346-702-3825. Or you can reach us online at foundationcheck.com. That's foundationcheck.com.
You found or inherited a great investment property. Problem is, you don't know how much it's worth, or more importantly, what to do to maximize your investment while mitigating risk. This is exactly why we started Next Gen Appraisals. Next Gen is a group of appraisers specializing in investment real estate. We understand that investors aren't just looking for a number of what their property is worth, but a comprehensive analysis of the market. Give Next Gen a call at 888-346-9911 or check us out online at Next.
Hey, Chris, I know that producing radio is not your full-time job, so what do you do when you're not producing?
$4 trillion in
My full-time job is this. We're back in one.
Okay. It is your full-time job is producing radio?
To fund all
Yes,
of your
sir.
Oh, wow.
Well,
Oh, good for you. Just for this station or for other stations also?
in Houston, Texas.
For this
At
station
Quest
only.
IRA,
Okay.
we offer retirement accounts that can be used to invest in real estate, promissory notes, private entities, and much more. Many of our clients loan money from their IRAs to fund real
but if
estate
you know anyone
deals
else who does
all over the
part-time.
country.
Yeah,
We don't
right.
sell any investments
Yeah.
or give advice. However, we do hold free networking
So how long have you been with this
weekly
station?
educational classes and
I've been
free
here for
consultations
3
with an
months,
IRA
three some
specialist.
change.
Okay.
For more information, visit our website at questira.com or call us at 1-855-FUN-IRAs to tap into the $24 trillion
Coming back
in
in 10,
retirement
stand by.
accounts
All right.
in the U.S. Call Quest IRA at 1-855-FUN-IRAs or go to our website, questira.com.
This is Business 1110.
Hot mics.
I like this music. Money, it's a gas. Hey, welcome back. Right Path Real Estate Radio, 713-785-1817. So Elle was asking the question, what happens if your capital is low to start? How do you get the funds, even with a hard money loan? So what I know is there's a lot of people that want to put their money to work. They don't necessarily want to find the deals or any of that kind of stuff. Now, we have a passive investor network for those people that just want to be passively involved. And if you want to find out more about that, what you need to do is come to our Wealth and Income Workshop. We have Ryan McCarthy runs that passive investor network. We actually find deals. We actually have an agency, a brokerage, a real estate brokerage that only exists to represent, investors finding, good single-family buy and hold properties. Now, I know of an investor here in town that bought over 100 single-family properties using other people's money, where he would find the deal, he would manage the rehab, he would manage the property. That's what he wanted to do. He was good at managing properties, and so he would partner with someone. They put up 100% of the money. So he buys a house for $100,000. They put $20,000 into the rehab or whatever it was. The asset's worth $150,000. So they just partnered 50-50. There was no debt on the property. It was because they paid cash for it. So there was no monthly payment. So they would split cash flow. They would split the appreciation. They would split the depreciation. So it gave some tax advantages to the investor. So it also gave the upside appreciation to the investor, the person putting up the money. So there was a win-win. You can run the math on that, and it works out great. Or you could do it differently. You could have a person, put the down payment and do the financing, and you could do leverage, but then you're going to have a monthly payment. It's going to reduce cash flow, things like that, so the percentages may change. So all that's negotiable, right? You get to create this, and we teach people how to do that typically in our base camp group. That's what we get into there.
2 minutes.
And so if you want to learn more about that, what I'd recommend, start following us, come to our events, come to our weekend event. Come to our free event. If you want to find out about all the events that we have, you need to come to the rightpathrealestate.com website. That's rightpathrealestate.com. And really what it is you have to understand how to run the numbers on each of these different scenarios. Each of these, and that's one of the things that I find is fascinating about most investors, that they really don't know how to do the math. They don't know how to do the math on building, taking a raw piece of land and building new construction, or, doing a tear down, they don't know how to do the math on how, what they could pay for the land or those kind of things. And we teach that. We're very strong on understanding the math, whether you want to do new construction, whether you want to flip, whether you want to wholesale, whether you want to do buy and hold. There's lots of different math choices from an investing standpoint. But all that comes through getting to know us and us getting to know you. And the best way to do that is head over to rightpathrealestate.com. That's rightpathrealestate.com. Because every situation is different. And so we don't have a cookie-cutter approach of this is what you've got to do. Hey, you're stupid if you want to flip. You're stupid if you... No, that's not true. We love flipping. We make chunks of cash in flipping. We love wholesaling. We love teaching that. We want you to be successful. But our favorite is buy and hold. You build the most wealth and income most passively, buy and hold. Go to rightpathrealestate.com. How much time?
20 seconds.
Okay. You build the most wealth and income through buy and hold. We love that the best. And we also teach lending. And lending can either be you being the bank, a private money lender, or doing seller finance. And I'm going to do a video soon about buy and hold versus selling with owner finance. And I like buy and hold better for long-term wealth. And I'll do a video on that, share that. You're listening to Right Path Real Estate Radio. Thanks for listening, guys. I'll be here tomorrow with Build Your Team Tuesday.